Okay. Okay. We are live. Welcome to the first UniWhales DAO community call. We have, I'm very excited to have Valentin Mihov. I should have learned how to pronounce your name before, but that's okay.
Oh, that sounds great.
Yeah, and Valentin, I mean, you're from Santiment that not everyone knows, especially if they're really new to DeFi, but maybe just give us a quick 30-second summary of your background in the crazy world of cryptocurrency.
Sure. So I'm a software engineer by trade, and I joined the Santiment team in 2017, just after the ICO, and I was the CTO there for about 2 years. And since this summer, I'm not part of the team anymore, and I switched to full-time yield farming, pretty much. So that's kind of the short story.
A full-time digital farmer. And I was really interested because you mentioned that, you advise people on how to yield farm. And today's goal is really to come away with the mindset, right? You can give a man a fish or you can teach a man to fish and just kind of learn about your strategy and how you approach yield farming, because it's not really just making money, but also minimizing risk, right? Because I can gamble in the casino and make money, but adjusting for risk, it still was not a good decision. And so I guess when it comes to DeFi, were you really early? Were you in right at the boom of it when things like synthetics essentially came back from the dead that dropped 99% in the ICO boom?
Well, I haven't actually followed synthetics too closely because it was quite a complicated project. And when it came out, I was involved in Santiment. I was not really super deep into DeFi. But my time at Santiment helped me out to get up to speed with blockchain and smart contracts and all this, because at Santiment we were doing data analytics for smart contracts. So we had to extract data out of these protocols and make sense out of it. So that helped a lot. And I would say that I was really started to do a kind of a yield farming maybe that was end of maybe 2019, maybe mid or end of 2019, when I was actually really fascinated by the idea of getting bankless. So instead of using, putting your money in a bank deposit, use some of these protocols to get better yield, like a compound, for example. So I was exploring these protocols. I also own some cryptos. I was kind of interested into, putting this crypto at work, and these protocols was coming together. So I was looking at them and I was putting, some dollars here, some there. I was also involved in quite early in this RealT project, which was real estate on the blockchain. So, which is, you can also consider it to be a kind of a yield farming. So, in that sense, I was trying to find, relatively low risk ways to put my money at work, but not so much about speculation, because I did speculation in 2014 with Bitcoin and I lost a lot of money back then, day trading. So my mindset is that I don't want to day trade because I'm not good at that. I'm going to lose money. So I'm more interested into, getting yield and maybe expanding my crypto portfolio when it comes to these big cryptos like Bitcoin, Ethereum, stuff like that.
Okay, let me try to summarize that. And you mentioned RealT, which I know David Hoffman of Bankless was at for a long time, and I think he recently left to focus on Bankless, maybe the biggest podcast in the DeFi space, which is really an interesting concept. Now, when I think about DeFi and crypto, I kind of look at it like this. There's farming. I dabble around trying to trade some of these coins as well as an amateur retail trader. But the whole idea is if I want to sleep at night, I'd put it back pretty much into BTC and ETH, maybe Monero, some other coins, but the kind of the major coins. But is that maybe a fair way to summarize your strategy, that like you make this money yield and you put it into the most stable of the cryptocurrencies today?
Yeah, so I don't try to buy coins because I want to speculate that there will be something big coming out of them, to be honest. Like I try to stay away from that, although it could be very tempting from time to time.
Right.
What I try to do is to farm coins, and in 95% of the time I just sell them on the market, and then I convert them to ETH. Well, currently my strategy is to convert them to ETH, to be honest, because I see a lot of potential in ETH growing as a platform, even like maybe even more potential than Bitcoin.
Okay, and so I had that towards the end of the interview, but let's bring that question up. This is from a buddy of mine that was with Augur for a long time, and I made a lot of mistakes just buying these governance tokens. And he said, Matt, you shouldn't buy governance tokens. Instead, farm governance tokens and sell them, which basically means yield farming and then selling them as profits. So even if the coin loses 40% in value, it's still a profit that you earned, and kind of developing that mentality, because even yield farming it's incredibly risky when you compare it to other financial instruments outside of crypto. It's very risky. So I think that heuristic really helped change my mindset. Although I continue to trade, but I've started to think more about earning money from farming. I guess strategies that work now, some of them didn't work before and won't work in the future. Like it changes quite a bit. In the beginning of DeFi, right, in the summer, there were abnormally high yields, right? And there's still yields to be had. So I'm very curious we got Twitter, Discord, UniWhales DAO. How do you, Santiment, how do you find new projects to farm in the first place? Because that's a full-time job in and of itself.
Yeah, well, it is, to be honest. And that's why I decided to switch full-time to it, because I figured out there is no way to do this effectively and also to be doing some software engineering job. It's just not possible. And at some point, actually, yield farming became more profitable than getting a salary at some company. So anyway, usually I follow social media. That's like Twitter, a lot of Telegram, where I follow some groups. Lobster DAO is a very good Telegram group.
Lobster, as in like the red lobster?
Yeah.
Okay, yeah. Lobster DAO. Okay.
Yeah. And then I also look on chain. I monitor where the liquidity flows, basically. So if I see that a lot of money are getting into some contract, I start to analyze this, figure out, okay, is this like a new farm? What are the mechanics behind it? Is it safe? And all this.
Okay. So you mentioned how you find it, and then is it safe so basically you find the farm, evaluate it, and then no matter what, even if it looks good, you have to make sure that there's not going to be an exploit of the contract you joined.
Yeah.
Right.
Yeah. That's the essential part. Yeah.
Can you think of any protocols looked at and you say, wow, this is not safe, and then later it got hacked?
Oh yeah. Koala Swap was a recent one. They had like a crazy API. Site looked really decent, like very nice graphics, everything. It was a SushiSwap clone. The contract was pretty much the same as SushiSwap. But in SushiSwap, there is a very common exploit that hackers, scammers are using. And this is the migrate function that allows you to drain the liquidity and put them into your own address. And this function was not behind the time lock. So I actually contacted the developers and I was like, well, why you didn't put a time lock at this? And they were like, yeah, we just need some time to adjust the weights of the pools and everything. And I was like, okay. And actually, this farm was sent to me by a guy in one Discord where I participate. And he was like, oh, look at this farm. The API is great. And I looked into it. I actually had to wake up very late at night to look into it. And I looked into it and I say, well, but that's not safe. I mean, even though the developers are saying that, yeah, we're going to put a time lock and everything, it's just not safe. They can steal your money. So he pulled out his money. On the next morning, they rug pull. So they run away with, I think, almost $1 million, maybe 800K or something. Wow. So yeah, I mean, couple of times it happened that I looked the farm, I determined it's not safe, and it turns out to be not safe.
Gotcha. Now, it seems like some hacks tend to happen with like stable coins, because basically being able to arbitrage the price, and like, pickle, die, and then maybe harvest, and definitely Acropolis that happens with that. Mm-hmm. Do you stake any stable coins in Yearn, mstable, or anything at the moment?
So I would say there are two types of say hacks where you can lose money. One type is where you have this obvious rug pull into the contract. So this is a farm that's its only purpose is to attract people and then steal their money using some kind of a backdoor. So these are usually easy to find out if you understand the code. You look at the code, usually they use some kind of an obvious backdoor. It's not too hard to find it. So these are the easy ones. You usually find them very easy and you don't participate at all. And then you have these protocols that are real protocols like Pickle, Acropolis, iEarn, and all this, that they don't have like a backdoor into them, but there is like a bug into the protocol that the developers, they don't know about it. But some hacker manages to find this exploit and he manages to drain funds out of the protocol. And these are much tricky to find, because if it's an obvious backdoor, it's going to be exploited very fast, and then it's going to be patched and all this. So how do you determine whether to participate in such protocols or not? That's the most tricky question. For me personally, so far, my philosophy is not to participate in any votes. So if there is a protocol that somehow you put money into it and then it pushes this money to some other place using some kind of a strategy or risk-taking or something like this, I just don't touch it at this moment, because when you look into it, like all of these protocols has been hacked. Only iEarn was not hacked, but actually it had critical issues that were found before they could be exploited. There were like 2, I think, security disclosures where there was problems in their protocols. Now, there are some protocols that are on the border. For example, Dracula, the Dracula 6 protocol. This is something that I published on official.
Sorry, Dracula, as in like Dracula, the movie?
Yeah. There is this Dracula.6 protocol or something. I actually used to farm this for a while because it was profitable. And this is one of the only protocol for which I published a kind of a public review about it. The team actually paid me in order to publish this review, and I agreed to do this because I was interested in the protocol, and yeah, I decided to take up the job, and I actually farmed it for a while. So in the Dracula case, I decided to participate because it was very, very simple way of forwarding the funds. So that was a kind of at the border. There was not involved like some complex strategies, being able to replace parts of the system with other contracts. There was no oracles, no conversion of funds or anything like this. So I decided that I'm going to participate into that. But all the other vault protocols that are more complicated, I'm just not touching them at the moment. And usually that's not a problem actually from a yield farmer's perspective, because these protocols, they implement some kind of a strategy. And usually you can do this strategy by yourself without a vault. So for me, it's much safer to implement the strategy manually instead of using a vote for it.
Gotcha. Okay. Okay. So implementing the strategy manually is just literally just finding them and directly on the platform. Like for example, I don't know if you use it, but like M stable save, you can go there and deposit MUSD and start staking. Gotcha. Okay. And so I think that's a nice heuristic for a lot of people in our chat are not developers. So just saying in general, as a heuristic, the more complex it is, and like you look at Pickle and YFI, they're incredibly complex and have so many moving pieces, the more likely there is for an exploit in general. Okay, that makes a lot of sense. Now, and let's talk about, I guess, okay, impermanent loss. This is another really important thing. And tell me if you agree with this statement. This is something that I've thought about. So a lot of people are like, okay, let's say you have ETH versus a token, you're staking that. And it could be Universe ETH, it could be whatever. And the coin, the token increases versus ETH. And you still make money, but they're like, well, you had impermanent loss because you could have just held the coin. And that is technically true, assuming that you don't get enough, the fees don't outset the gain. But let's just say that's true. But the way I look at it, it's like, yeah, but what you don't see is my downside protection because I believe ETH is a very safe asset. This coin could have also tanked by 50%. So I in terms of risk-adjusted return, it could actually be a lot better than having made more money just buying the coin and selling it. Do you think you could shed some light on that? Because I know you advise clients on stuff like this.
Well, so it really depends on your what goal you want to achieve. If you're, for example, having a portfolio that you monitor in dollar value and you don't want to have any exposure to crypto, you need to properly hedge your positions. It's getting actually quite complicated in that case in order to get it right. But I mean, that's one case. For me personally, I think Wi-Fi, it's a very good example because I farmed certain amount of Wi-Fi and then I was liquidity providing Wi-Fi for a very long time. And when I talk with investors about it and they're like, well, but aren't you afraid of the impermanent loss because the value of Wi-Fi went up a lot against ETH, so now you own less Wi-Fi tokens. But I'm actually fine with this because for me, I'm interested into growing my overall portfolio as a dollar value. Okay. So my personal belief is that Wi-Fi is not going to go down to zero. So in that sense, I don't know where the price is going to go. But what I see is that if Wi-Fi is earning a lot of API from fees, usually over 30-40% annually. And then ETH Wi-Fi is a token the LP token that I can use for farming. So it gives me a lot of yield on top of that. So I'm fine with that. This is like an asset that I can use to get a lot of yield out of it and grow my portfolio. I can start speculating where the price of Wi-Fi is going to go, but this is a completely different game. I don't try to speculate where the price is going to go. I try to optimize my yield and how much I'm going to earn on my portfolio over time. That's the important part for me. So if I have a token that I believe is not going to go down to zero, I'm perfectly fine with liquidity providing that on Uniswap if I get good fees on top of it.
Okay, now so two questions here. One is, I know there's Uniswap ROI and someone shared in our group, but I forgot the name and I still can't find this link. But one is, how do you track your APR? And then two, what APR do you look for your entire portfolio?
Well, I use Excel, not Excel, but like Google Sheets.
Gotcha. With an API there?
Yeah. I also use Zerion and Zapper because I want to know, for example, what is the cost of the LP tokens. this is something that only Zerion is having at the moment, like where you can click on a, let's say, Ethereum USDC, and you can see how much a single LP token is the cost of a single LP token. So I take these prices manually, I put them in Excel, and this way I can see how big is my position in a given liquidity pool in Uniswap. And then I also in the same spreadsheet, if I stake these tokens somewhere, I track the API there, and I compute the whole API of my portfolio. Actually, it's a little bit more complicated because in order to maximize my API, I also use lending protocols. So for example, if there is a farm that for which I need, let's say, stable coins, like if the current strategy is that I need to use stable coins to farm something, then I'm going to put all my assets on Aave or MakerDAO, and I'm gonna borrow stables, and then I'm gonna use these stables to farm, right? So I need to track how much I put as collateral, how much I borrowed, what is the APR I earn from my borrowed assets, and then translate this APR to my whole portfolio. And then I'm able to see, okay, on my whole portfolio, this is the amount of return that I get. Now, at the current state, I'm trying to keep about 100% APR for the whole portfolio. But this is like a moving target, and it's kind of dropping at the moment. Actually, it's a bit chaotic right now, and yeah, the last time that I was doing the whole reconciliation, it was about 100 APR.
Gotcha. So just for listeners to understand, in case they're lost, if I started with $20,000 today and I wanted 100%, that means a year from now, and I realize it's a long time in crypto, but a year from now I had 40,000.
Yeah.
Okay. And now let's talk about, okay, so you mentioned the lending issue, kind of staking and lending. Like you mentioned Aave, you mentioned Maker, there's also Compound and Cream. And so when it comes to risk, one thing I noticed, I know things have changed because YFI recently just had a merger with Cream and pretty much everyone in the space. But when I started looking at it, I read that, okay, Compound usually gives lower APR than Cream, but it's a lot safer. Again, this is what I read. And so I'm curious, with those 4 protocols I mentioned, do you stay away from Cream? Has it changed? How should one think about that? And also another thing is when you're borrowing stable coins, right? Like on Compound and Cream, right? Let's say I put WBTC, right? I think it's up to around 80%. I could be wrong. So you can actually get liquidated, right? And so you never want to get liquidated. What is a safe margin for you to make sure you never get liquidated?
So first, I use DeFi Saver to be
DeFi
able
Saver,
to,
okay.
yeah, DeFi Saver to be sure that I have automation in place that is going to protect my position in case I'm away from my laptop and suddenly the market crashes a lot. So
can we go into that for a second? So you're saying
yeah.
DeFi Saver, let's say, okay, I'm in Compound, I'm staking Uni to borrow USDC, for example.
Yeah.
I can set up something that says, hey, if my Uni is about to get liquidated, pay back the USDC. So
yeah,
that
the way it works, so in Maker, it's really bad if you get liquidated.
Okay.
The penalty is huge. I think it's 15% or something like this. And actually on Black Thursday, some people lost all their collateral. I mean, it's really bad. So you really don't want to be liquidated in Maker. So the way it works is that you open your CDP, like your loan on DeFi Saver through their UI, and then you activate their automation tool, and the automation tool allows you to say, if my collateralization drops below, I don't know, 170%, then sell some of my collateral and return some of the loan back until you reach, let's say, 200% collateralization.
Wow.
And this is going to save your position from liquidation. You're going to lose some money, but it's much better than getting liquidated. So this is my last, like the last resort backstop. If suddenly something happens, I'm not able to react or something like this. This is going to save my position and from liquidation pretty much. They currently support Maker, Compound, and Aave. So you can do this for all of these protocols. As of the level of collateralization, I keep my collateralization Maker on 200% and on Aave on 150% safety ratio. So these are my levels.
Wow. Okay. I appreciate that. So everyone listening, DeFi Saver, I'll share a list of, Lobster DAO, DeFi Saver, things that Valentin mentioned here today. Okay. Well, now when it comes to, well, let me ask you a question. What is the biggest mistake you've made so far as a farmer?
Well, I haven't really been involved in a hack, which is good. So far, I haven't been rugged pulled. There is, I'm not sure about mistake, to be honest. I can't think of something right now, but there is one particular story that I would always remember from the summer, and that was kimchi, the kimchi farm.
Yeah.
Maybe some of you know about it. It was a wild story. It was at the time where there was farms popping up left and right. It was really hard to sleep, to be honest, because there was always new projects coming up. And then this new kimchi farm comes in, and the API is just crazy. It's like 100% per day. It's crazy. And I start looking into it, and I look at the contract, and initially it looks like it's not safe. I think it was clone of sushi, maybe, or something like this. But when you start looking closer into it, it looked like they were able to steal the funds. But then when you look closer, they actually did certain things into the contract that kind of whoops over the ownership of the contract, which makes it so that nobody can actually steal the funds. So it was very interesting, because at that point I was like, okay, so people probably look into this thing and they think, okay, this is a rug pull. But when you look closer into it, it kind of looks like it's not a rug pull. So this is a kind of an edge over the market. So if you participate in this early, there is a potential to earn a lot of money. So I decided to ape in, and I play pool too, at that one, which is I almost never play pool too.
Let me just define what pool 2, just in case people. Pool 2 is basically when the token that's running the farm paired usually with ETH, correct?
Yeah. So it's usually the token that is being farmed paired with ETH. So you're exposed to huge impermanent loss. And usually this is where all the earnings are coming, from all the participants in this pool that are thinking that, okay, this huge API is going to offset the drop of the price of the farm token. But usually that's not the case. It's a zero-sum game. All these farms are a zero-sum game, and the earnings are coming from this risky pools. So I usually don't participate in these. I just farm the stable pools and I sell the tokens. So at that point I was like, okay, I'm going to play this pool too. And I didn't put all my portfolio into that. That would be crazy. But I was farming something else before that. Maybe it was sushi or something. So I just converted all my earnings from this protocol to pool 2, and I put it into it. But I mean, it was a significant sum. I don't know, five figures or something. Yeah, and it was not small. And I wake up on the next morning, and the rewards, the rewards were doubled. Like it managed to achieve 100% API in like 8 hours. I mean, it was crazy. And at that point, instead of cashing out, I decided to reinvest the earnings into the pool too. And like in 6 or 7 hours, it dropped like crazy. I mean, at the end of the day, I think I was like break even or something. I mean, it was like all the earnings were gone. So that was like the most wild rides that I would always remember this summer.
Awesome. And how's your temperament? Does it psychologically, does that stay with you for a few days, or are you able to get over things like that quickly?
Um, well, for this particular one, I didn't really feel too bad about it. Like I didn't lost money out of it, which was good. Um, I also try not to have this mindset where, okay, if I have done this, I would earn that much more or something, because this is really a bad way of thinking about it, and it's also a bad way of thinking when you are trading, because in a hindsight, there is always a better play. There is
Mhm.
always a better way that you can earn more, but when you need to make the decision at that particular moment, you don't have this information, so there is no way that you'll be able to pull off this play. So I think in 2014, when I was day trading Bitcoin, that kind of trained my mindset not to think about, okay, I could have earned more, or oh, look at this coin, it mooned like 50%, I need to ape in or something like this, because this is a path to destruction. So I just try to be systematic about it. So don't play pool two, don't go into votes, stuff like that. Be really level-headed about the risk. So if you're making money, you're good. So that's it.
Gotcha. And well, Valentin, it's really cool for me to think you're kind of like the guy that if I'm on a DeFi project and I get a message from you on Telegram or Discord, I better listen, because it's really awesome that you point out to projects vulnerabilities and that they didn't realize. I'm sure there's a lot of people like you in the space, but it's really good that you do that. And to finish up here, yeah, of course, the predictions, not what the price of Bitcoin will be. Don't worry, I know that's the question everybody gets asked, but just will yield farming evolve? Is this going to be looked at as a fad, or do you think yield farming is here to stay for the next 12 to 18 months?
Well, to be honest, 2 months ago, when people asked me the same question, I would say like, well, yield farming is gonna go on for like 2 more months and that's it. But here we are 2 months later, and it's still going on strong, and I'm really actually surprised about it. And yeah, I mean, this could not go on forever. These returns cannot sustain, because the market is getting more and more efficient. And I see this, starting from the summer, how the returns are dropping down. And this is normal, because money are getting smarter. So when they see such kind of opportunities, they're going to jump in, and they fill them in. So the returns will be normalized. So I think maybe it's gonna go on for a while. For now, my strategy is that I try to use this opportunities as much as possible, to grow my portfolio as much as possible, and then when the returns normalize, my end goal is to have a big enough portfolio so that even when the yields are lower, and by lower I mean things should be below 10% API. I think that's kind of the normal look at the things. Now, in the normal TradFi systems, it's less than 1%. But if we consider that DeFi is the new banks, then I guess 10% is probably making sense. I hope banks are making 10% over our money.
Yeah. Well, a lot of people don't realize like you get used to this. And I think that's important too, to like recheck your expectations. Doesn't mean that there won't be amazing opportunities, but understanding that 10%, assuming you have safety and you're using, cold storage, and you're staking on the right safe protocols, 10%, you'll never find that in a bank account. I can't, I don't know when you'll have like an actual US dollar or euro or whatever bank account where you get a 10% return.
Yeah.
Okay, well, Valentin, this was amazing. I want to make sure we get to some listener questions here from the Q&A. So I'm going to read a couple here for you. So the first one, and feel free, if it's not your expertise, we can skip them. And listeners, feel free to, UniWhales DAO family to put in more questions here. But the first one is, any thoughts on, I think they're PowerPool CVP, because it's another complex structure, and someone with your expertise, have you taken a deep dive look at it?
So I started looking into that because it looks interesting. Also, the returns look interesting. It's a fork of the Balancer protocol, but I haven't actually wrapped my head around the changes that they did. So I would probably continue looking into that for now. Like for now, I'm kind of looking into it from the side. I haven't used it for now. So we'll see how that goes. But I think it looks interesting, definitely.
Yeah, I don't know if anyone saw this, but they had 3 rounds of testers for their product, and I think they gave away like 50,000 of their tokens. Some of them are vested depending on what round you're in. So that would have, just for testing their product, now that's worth like $150,000. Insane.
Yeah.
And I know Delphi Digital invested. I know they added a couple of things since I first looked at it, but they allow for essentially, voting power and governance protocols, which is pretty cool. And I know Compound's doing something like that for Uni, but cool. So something to pay attention to, or at least explore. Next question. What do you think about the DeFi ratios, like market cap versus TVL, or fully diluted market cap versus TVL?
Well, I guess they should kind of make sense. Evaluating these projects is really hard. It's like when I look at tokens, I usually try to figure out, like, my rule of thumb is this token going to give me yield, some kind of yield? Let's say Sushi is such kind of token. It gives you yield because it collects fees from the swaps. Wi-Fi is also such kind of token. I hope Uni is going to become soon such kind of token. So if the protocol allows that the governance token give you some kind of a yield, then I'm happy about it. And this is a token that I like. If it's just a governance token that can be used for voting, I don't know how to value this, to be honest. So I'm not so keen on keeping such kind of tokens.
Cool. And okay, so let's see. Well, interesting. I'll go to the most recent question from YVR Trader. Before we started recording, you and I were talking about Sin and SynLev. And he says, seems like Sin is interested in a code audit based on a comment from Icarus today. You actually did look at their code and contact the team a while back, correct?
I talked with Icarus a few days ago. I actually, they were looking at some potential problems with one bot that was running in their protocol. So that's why they had to increase the fees. I also looked at the code a little bit more after that. But it's quite the way they determine the prices of these tokens. It's not very simple. So I really didn't have time to dive really deep into it and figure out how it happens. I'm kind of cautious that there might be a way to exploit the protocol in a way where you're able to do profitable trades without by observing the price oracles. I talked with Icarus. I think he said that he has an idea about how to fix it. Now, as the trading fees are higher, this bot is not active anymore. So that's good. But yeah, I mean, it's definitely something that needs to be looked at. I haven't been able to wrap my head around how they determine the price of these tokens, to be honest.
For sure. Yeah, I guess for me, I related to that. I guess I lost out on YFI in one way, but I was unable to understand. It's a brilliant idea and protocol and execution by everyone there. But I was just trying to caution myself. Yeah, you can make money on this, but I couldn't explain to someone fully what the value of YFI was. I know many people can, but just based on my own limitations, that's why I didn't invest in it. And hopefully for the long term, I think Warren Buffett, Charlie Munger, traditional people discuss that. We'll give one final question here from Sora, and I guess a two-part question. What do you think will come to crypto season after DeFi? I'll combine all those questions here. What do you think will come to crypto season after DeFi? What about the options protocols like Hedgic? And can you leak us some alpha in your radar right now? Had to ask.
So I think what I would like to see happening with crypto after the DeFi season, I guess, is over, will be my longer term plan will be just to liquidity provide. Okay. I mean, the moment when you build a portfolio and you have enough liquidity, being just a liquidity provider in these protocols should give a good yield. And as the whole crypto system grows and more users are using it, and I don't know, even bigger institutions, maybe PayPal, start using it or something, I don't know. As these protocols have a lot of volume, they should harvest a lot of fees. So I hope to, at one point, just settle as a liquidity provider in, Curve or Uniswap or Sushi or whatever, and earn yield on fees. That's the best long-term plan I can think of, to be honest.
Yes, someone told me, pretty well known in the DeFi space, I won't name him, but he basically said, yeah, if I had $20,000 of stable coins, I would put into, I think it was USDT and USDC, not on Curve, but on Uniswap, because at the time the APY was like 20% and just park it there, assuming you believe those coins are safe. And I know that there is, we forget that there's been a lot of sketchy things that have happened with Tether in the past, but to their credit, still it keeps getting bigger and bigger. But anyway, those types of strategies are interesting. Just, you've made some profit farming and then just become an LP on Uniswap, Curve, or maybe Sushi, which we are actually launching an alerts channel soon for Sushi. Okay, well, Valentin, I wanted to thank you so much for your time today. We were learning a lot from you and your experiences, and everyone in the community. I think it's safe to say that we're really happy to have you on and also have you a part of the greater DeFi and Ethereum community.
Yeah, thank you. And yeah, about leaking alpha, that's an interesting question. I mean, to be honest, what I figured out is that people are actually willing to pay money for alpha. And this is another reason I decided to do a full-time yield farming, because I have, like a client that pays for giving him alpha, which is really awesome. Like, so I try not to give up too much. But I probably can say that right now this basis cash thing looks very interesting. So that's a protocol that probably you heard about, and a few days ago it kind of bent the whole crypto space. Like gas fees were high, stable coins were getting off peg because of it. I mean, it was crazy. So I'm kind of monitoring that and really curious where it's gonna go. So we'll see.
Basis.cash. Okay, cool. And one last thing I wanted to add, I forgot to ask you. You mentioned like getting up in the middle of the night. This has happened to me. I get a CoinGecko alert that Pickle is up like 50%, and then I'm tired. Like I'm going back to bed, and I wake up in the morning and it's gone down again. So this is a 24/7 market. I know 1inch has it, but limit orders for me, I still don't trust limit orders to execute. And I know it's a really high gas. So how do you reconcile that? You're just one person, meaning you have to sleep, I think. And you're going to miss out on certain returns because you're just sleeping. Like, how do you manage that?
Well, I try not to time the market. Like, okay. I just repeat to myself, it's hard to time the market. You can never do it precisely. So just continue, regular farming, no matter like the price dropped, like just sell, like have like a schedule. Maybe if you participate in a given farm, you're gonna farm, harvest, and dump like once or twice a day. Just continue doing your thing, no matter where is the price, and yeah, like don't think about price too much.
I like that. So kind of like, they're investing, whether you can dollar cost average buying Bitcoin or Ethereum. It's like dollar cost averaging when you're selling those farming tokens that you've farmed.
Sometimes I try to think about, let's say, okay, maybe the price of ETH is very high right now, like all-time high. Maybe I'm going to convert my farm to stables this time, not to ETH. And then, the ETH price dropped a bit. Maybe I'm gonna convert it now to Ethereum. But I don't know. I mean, it's really hard to time the markets, to be honest.
So
like, it's always you're gonna miss it. So, and that's actually one of the problems with bull markets. You never know when to sell.
Oh man.
So I don't know. Like I prefer to look at my portfolio more of how much yield I get on top of it. And make sure that I have the right proportion of crypto versus stables, and that's it.
Okay, last question, I promise. Of the stable coins, like the main ones are USDC, USDT, DAI, I guess MStable or MUSD is coming up, Binance USD. Do you have any preferred ones or ones you stay away from?
Well, there is this USDN stable that was based on the Wave blockchain.
Mm-hmm.
It gave very good return on Curve. I think maybe it still does. For example, I kind of stayed away from this one because I'm not very familiar with the Waves protocol. It's like the whole new blockchain. Although I have some people even from Curve telling me, like from the Curve team telling me that it's actually a good enough coin. Like if it was not good, they wouldn't include it in the Curve at the first place. But I kind of stayed away from this one. Also, I stayed away from this O USD that got hacked because it looked a bit too complicated to me.
Can you say that one more time? The all USD?
O USD, yeah.
Oh, USD, okay.
O USD, yeah. It got hacked a few days ago, I think, like a week ago.
Gotcha.
It looked a little bit too complicated to me. So I also kind of stayed away from this one. So yeah, I guess that would be my thinking. If it's too new or too complicated, maybe stay away from it. So try to, I mean, if you liquidity provide in SUSD ETH, you get quite nice return. So I mean, why look at other coins for like a 5% more or 10% more? It's just not worth the risk.
For sure. And I agree there. And I just pasted your Twitter, Valentin Mihov, ValentinMihov. Make sure to follow him on Twitter. Okay. Well, thank you so much, Valentin. Thanks for being part of the UniWhales DAO first community call, hopefully the first of many. And we will be following you closely as hopefully this DeFi thing keeps going for at least a few more months.
Yeah. Thank you for having me. It was a pleasure.